Let's broaden out the ETF conversation. Bring in Todd Sohn. He's the head of ETF and technical strategy at Strategic Securities. Todd, there's a lot of moving parts, stocks, bonds, and ETFs these days. You had a great piece out last week. We have the S&P breaking maybe to a new 52-week high. We'll see if that happens today. You've written that with equities continuing to improve, the potential for a FOMO tidal wave is building. What is that mean?
And oddly enough, today's the eighth month since the October low, June 12th. And what stands out to us is the sheer amount of money that has gone to money market funds since that low, right? And given you're at 5% yields with no volatility, that's great. But you're at a ratio of 15 times to what you're seeing in equity flows, particularly since the regional banking episode has happened. And so I think a lot of folks, investors, are off sides in terms of their positioning. They don't believe in this rally. It's a very uncommon bottom if this is the bottom, right? You didn't have the broad-based surge. You didn't really have much of a dash for trash, right? Small caps are still lagging behind. But the further and further away you get from 43.25, that's the last August high, I think that FOMO case is really going to build, and investors are going to realize that they're underweight equities and need to catch up. Perhaps some of that money comes from money market funds, too.
You know, why is it that equity inflows have been so anemic this year? And you might say, well, everything else because tech has outperformed, but tech ETF inflows have been even negative. Even the QQQs, XLK, the technology ETFs, even Cathie Wood, the ARK funds.
It's very strange. There's a lot of disbelief towards this tech rebound. I think everyone has this mindset of the Fed's not done with their interest rate hikes, and that's going to negatively impact these names, and that it can take years for them to rebound in terms of leadership, right? That's what happened in the tech bubble. Well, we're in a different scenario now. And I just think a lot of folks were burned last year. 2022 was a rough year. And so you're not seeing the flow breadth in terms of all the corners around in the market. You know, a lot of these products are not getting inflows. Thematics are particularly not seeing much of a bite. And I think that's really why you're seeing such anemic inflows overall.
I keep talking about the pain trade being higher. The pain trade exists in the ETF business, too. I mean, people are off sides. They don't believe in they don't believe in the rally. They don't believe that we're not going to have some horrible recession. And so they're positioned the wrong way. And as the market keeps rising, it eventually forces people back in that are active traders.
You're going to have to. And I do think that the money market component, some of that money will be sticky, right? Because everyone's happy with 5% yields. That's halfway to a decent equity year. But those who are more actively in trading involved are going to have to take money out, and that's going to help boost.
We started out the year with all the wags saying, oh, this is going to be the year when the equal weight ETF is going to outperform the RSP because that's more value-oriented. But as you pointed out, it's underperformed. But that happens a lot, right? People try to think they can pick these things and say, oh, you know, there's a reason that market cap S&P 500 is the standard and not equal weight. There's a reason for that.
I'm sympathetic to the idea of equal weight because it allows you to get a little bit more diverse exposure. But as you say, the market is voting for Apple, Microsoft, NVIDIA, these top 5 weights. And I know there's a lot of consternation, right? Top 5 stocks are almost a quarter of the index. But this is how market cap weighted indices work. The biggest names and the best players are supposed to have the greatest influence. Now, if you're just trying to gauge market health, that's where the equal weight S&P 500 comes in. That's where the VXF, the Vanguard Extended Market Fund, comes in, just to judge how participation's going. But it's real. I mean, this is a dream for passive, and it's a nightmare for active investors right now.
And small caps are finally starting to do better, but only recently. In the last few weeks, since, frankly, the jobs report, we started seeing small caps. This is a sign that people are starting to quasi-believe the soft landing, but I wouldn't say it's convincingly turned around.
Small caps are tough because they have too many regional banks that are struggling, and they have a lot of boom and bust biotech. So if the IPO market gets running again, maybe that helps biotech, and that should help lift the small caps. So, you know, you can get your beta exposure for small caps, IJR, SP, SM, I want to say from State Street. But if you wanted to go a little bit different exposure and you want more discretionary and industrials, RWJ, it's a revenue-weighted small cap ETF. So you're getting away from the banks, you're getting away from healthcare. I think that's interesting, and I would also consider global small caps. They've acted way better than U.S. small caps because they're more cyclically oriented. And perhaps that's saying the recession case is not happening this year.